Hi guys, it's Yashi and welcome back with another market update today. This time I'm gonna focus more about the broad market instead of just crypto like I did this morning. This morning was a live, this will be just a normal video. I'm planning to release these formats of the videos on a daily basis. I know it's a lot, but we'll see what happens. This time here, we're gonna look both at articles but also data. Because as you may know, media likes to exaggerate stuff or even sometimes say stuff that is based on older data than what is coming out now. So let's start here with real estate. Real estate, as you all know, I've seen it on many other articles in the past couple of weeks. Everything is very negative. Housing prices, why real estate is plummeting, but not everywhere. So here's somebody's giving you a false truth or being a little bit more positive. Housing market has big disconnect and prices have a long way to fall. What is this guy saying? Disconnect between sales of new home, mortgage demand is not sustainable according to Pantheon macroeconomics. Why is it not sustainable? When the new home sales in September fell 10.9%. Rates are very high. Surpassed 7%, expanded supply of new homes September expanded to 9.2 months worth of sales in September. No, actually not. I don't know where to get this data from, because even if you look at the National Association of Realtors or even Zillow, the supply is actually much lower than that. It has been increasing, but it started plateauing and might decrease again because people are not putting their homes for sale. So yes, demand is down, but not down enough. We saw an article the other day on Fortune that if I look up right now, housing market activity, this is 2 days ago. I believe this is the stuff I saw the other day. It's not this guy. No. Is it this guy? %2 target rate, 8.2% is not this one. I remember I talked about a Fortune article that said that the mortgage demand dropped to the levels of 2014, and I simply reminded the fact in 2014 the mortgage rates were almost half as much as today. So with worse market conditions than today for buyers, there's still demand, the same demand as there was in awesome market conditions with lower home prices, with salaries that didn't really increase that much. So to me, that was actually a message saying that even with high interest rates, there's still a lot of demand and supply, and the demand did not drop enough to offset home prices. Now, if you look at mortgage rates, there's one interesting thing I saw. It seems to be super convenient nowadays to go from 30-year to 15-year loan. The discrepancy is much higher. When I got my 15-year loan at 3%, the 30-year loan was at 3.6%. Now, and this was 3 years ago, now the interest rate on the 30-year loan is around 7.24. A 15-year loan is 5.69. If you do it on a $325,000 loan, that's a $500 difference. I know it's a lot, $500, but you're paying the loan in 15 years less. So it's quite a big difference, and most of it goes straight into principal compared to a 30-year loan. CPI. Now I want to talk about general inflation. Why? Because I saw some really interesting stuff today. So as you know, the last CPI report came out at, let me update this guy again, it came out at 8.2%. If you know, the Fed does not look at all items, they focus on core inflation. So all items less food and energy, which is funny because it's the most important things to live off, but okay, whatever. If we look at some factors of inflation, like for example, transportation or cars, let's start with transportation. Transportation was one of the biggest drivers of inflation, 14% in the past month. And I read a really interesting article, namely this one here on oilprice.com. It came out today. It was saying that the peak shipping season for truck and rail transport is underway, but it's not really being as normal as it should be. It's not really being peak. The numbers are not as good. And why is so? Let's look at some data that these guys pull out. OTV, trucking executive are wary, trucking. Okay, let's start with ocean spot rates. And I have been affected by this on a personal level. If we look at container costs, shipping costs, a 40-foot container from China to the US and West Coast used to be $9,630 in the beginning of this year, or during the middle of this year. Now it dropped all the way to $2,470, 70% lower. That's a big collapse. I don't know if this will result, something like this will be part of the inflation report we're gonna see next month, but this is a big drop, which could contribute to most of the transportation costs. The question is this happening only from China to America or all other routes? What it's basically also saying is that container companies don't have the price strength and the bargaining power they used to have before, because demand is dropping a lot, which means that consumption is dropping, which means maybe we're gonna see a little bit of turnaround. We'll see. On top of that, trucking turndown materialized too. Moving on the contract rates dropped by, truck requests dropped 12%, which means that bargaining power will drop again and prices might drop again. Trucking executives are wary. Okay, anecdotal, we hear from those having receivables with small carriers and it has turned very ugly quickly for them. Still we typically get some, okay. It's rare that you go into a fourth quarter, peak season of transport, and not see some type of seasonal uplift and project and spot opportunities, especially if companies of our scale, we typically get some of these large, kind of difficult projects to handle and typically pay a premium. None of this stuff has materialized yet. AKA, stuff is slowing down. Prices might come down in general transportation. Gas prices are going down, although it does not affect core inflation as the Fed does not look at gas prices, but it's still good news in general. Another very interesting thing is used car prices are dropping. We saw a 50% increase during COVID of used cars because of the chip shortage and everything. It seems that people are not buying anymore and dealerships are forced to drop prices. Another thing I saw, I didn't find an article yet, but I saw some YouTube videos, people talking about dealer auction prices are going down too. So there is a general slowdown. I know it's not really good news from an economy perspective, but if you think about interest rates and the Fed that keeps on pushing these interest rates up and everything, seeing a slowdown in everything and even price drops is a good thing. The only thing that is staying pretty stable are the food prices. They're still increasing in some sections, decreasing in other sections. Wheat will be a little problem. I need to find some articles on that too. We're gonna see in the future. Guys, that's all for now. The general thought I have from this update is the interest rates I believe will still go up. This is my general belief. This is not financial advice. Do your research. If you look at general sentiments out there, what the market feels, we're gonna see a November hike for sure. December hike, there's a more than a 50% chance according to the market. February 33, March 9%. So beginning of next year, many people, most of the people believe that there will be a pivot from the Fed. Looking at the data now here, dropping some of the most, let's say, influential data points for inflation might result in what we saw there on those ratios. Because if prices drop, it means that the Fed is having success, which means that the Fed might be slowing down in the near-term future. I don't know, will this happen? The underlying data seems to look pretty good. I'm curious to see what the next CPI report will say, but it's another 15 days. So we're gonna see. Guys, that's all for now. If you have any other news outlets you want me to use, data points you want me to pull out to give a general opinion, please let me know. Thank you for watching.